Okay, let's get going. I am Nathan Gustorf. I'm the Executive Director of the Fiscal Policy Institute, and welcome to our annual budget briefing. This is something that FPI has done for a long time. Normally, we will look at the governor's budget not long after it comes out, put together an analysis that's both written and in a presentation like this, and then we present it in an open to the public forum. So we've got a lot of people with us on Zoom. We're also live at UFT headquarters, and we've got some people in the room. So I'll be going back a little bit, back and forth between our real audience and the Zoom audience. This is going to be about a 45-minute presentation. It's an overview both of the fiscal aspects of the executive budget, meaning what's going on with revenue and spending, and also some of the major policy domains. At the end of that 45-minute talk, we'll then take questions. And again, we'll kind of go back and forth between the live audience and the Zoom audience. If you have questions, feel free to drop them in the chat anytime, but we won't reply to the questions until we actually get to the Q&A period of the presentation. All right, with that, let's get started. So again, there's sort of two parts to this agenda. First, we're going to give an economic update about how things look in the state and a financial plan update on, again, spending and revenue trends in the budget. We good? Mm-hmm. Spending and revenue trends, how do you sort of put the pieces together in a way that makes sense of the numbers in the budget? Then we'll transition into a discussion of the specific policy areas. So we're going to talk about spending trends in education, in healthcare. We'll talk about the governor's housing initiatives. We'll also talk about climate policy and why we think that's an important discussion to have in a budget presentation. And then we'll go over tax policy and talk about some revenue options and what we think is on the table in terms of increasing state investment in some of these key policy areas. All right, so this will be relatively brief, but what's going on with the state economy? What's the context in which we are having this budget debate? Well, we're still coming out of the COVID recession. Let me get that out of the screen. Employment in the state has not fully recovered to where it was before. And this is about the overall labor force. So this is about 120,000 people who have potentially permanently dropped out of the labor force. We don't know, but it's related to the state's population loss. We've written a lot lately about the trends in people moving out of New York State, particularly low and middle income New Yorkers, probably because they find it tough to afford to live here. So even though the unemployment figures, people who can't find work and are looking for work, are relatively low in this state and have recovered, this shows you that we still have some lost ground when it comes to the overall state's labor force. Importantly, this is distributed very unevenly throughout the state. There have been job gains concentrated downstate and in the city, particularly in Brooklyn, actually, and in Queens. But throughout the upstate regions, there's a lot of variation, and most counties have seen some job loss. In particular, you can see in Western and Central New York, fairly considerable job loss. Other important contextual points. We'll talk a lot about affordability. That's been a theme of the governor's budget, we think appropriately. It's something that we've given a lot of thought to. It's important to keep in mind that housing prices have risen very significantly. They're up over 40% since the start of the pandemic. Sorry, people are still coming in. Those rises in housing prices and rising rents are putting a lot of pressure on really all working New Yorkers. And we think that's closely tied to the population loss trends and the employment loss trends that I was just talking about. We've also seen a rise in poverty. During COVID, poverty actually came down, and that continued a trend that had been in place during the 2010s. Particularly during COVID, all the federal stimulus payments really brought down the overall state poverty rate. Once those tapered off, we've seen a fairly steady rise back to where we were right after the Great Recession. This is obviously concerning trend and something to think about when we get into the policy proposals in the budget. That poverty trend is also tied to the extreme inequality in New York. And this has really been a feature of New York state economy for a long time, but it's actually risen in recent years. The one way, there are a lot of different ways to slice up inequality statistics and try to make sense of it, but one of the most straightforward is just to look at average incomes. And if you take the average income of the top 1% is over $2.5 million. The average income for the bottom 90% is about $50,000. So that probably tracks with what you would expect in a state that has a large concentration of extremely high income earners. But those numbers really tell you about the fairly extreme distribution, maldistribution of income. Okay, so again, just in the back of your mind, we've got these unemployment, or rather these employment losses, inequality, poverty, and that's the economic context of the budget. But what is in the budget? Well, if we look at the financial plan this year, you've got about $129 billion in total state spending. As they have to every year, it's a balanced budget, so that matches the state's revenue projections. And this just shows you the basic breakdown of state spending, mostly across healthcare and education spending. Let's start to get into the numbers. So here we break down some of those big categories. School aid is rising, but it's actually rising by less than it was projected to based on changes to the school aid formula, but it's still going up by just over 4%. Medicaid spending, on the other hand, is going down a little bit. And so we'll talk about the cuts to Medicaid spending and how to make sense of those within the budget. This budget adds assistance for New York City. It's not at the level that the mayor has said is needed to actually address the migrant crisis, though we have in the past questioned whether some of those estimates are too high, but the state has thrown in about another $800 million to aid the city's costs for migrants. The other thing you'll see down here is a little decline in state operations. That basically just has to do with the timing of payments and isn't really consequential for the level of service provision. Where this starts to get a little bit more interesting for the way that budget debates work is when you look at the revenue detail, because budget debates tend to be organized around concerns about the sustainability of state spending. And that's what a budget gap is. Whenever you hear, oh, the state has a deficit or we have expected budget gaps, what that means is that the revenue expectations are pegged below their spending expectations. And so this breaks down the different components of revenue expectations. And we'll get into some more detail on this, but basically they expect pretty ordinary growth in the income tax, very low growth in business and corporate taxes, and very substantial declines in all these other little taxes. The net effect is that they expect almost no revenue growth. And to us, that does not exactly make sense in economic terms, because all those other little taxes that they say will decline by about 13%, those are spread like throughout the economy. They target lots of different little sectors. So you would expect to see somewhat more consistent trends, not these very divergent trends that net out to no revenue growth. The last sort of big category when you're looking at the state's finances, you go, what are the spending trends? What are the revenue trends? And how much do they have in reserve? Because the reserves allow the state to smooth out spending when those other numbers are off what they're expected to be. Well, the state has done a lot to boost its reserves in recent years, particularly because revenues were so high during the COVID era that they got these surpluses that could be put into reserve. And so the sort of public figure is that the state has $20 billion in reserve, 19 and a half, to be specific. Okay, when you go actually look at the way that they do their accounting, that reserve accounting breaks down into a few different categories. There's like a statutory reserve that means reserves that are under certain legal restrictions that can only be taken out in prescribed economic downturn conditions. And if you don't meet those conditions, then the state can't withdraw money from that reserve account. But they also essentially just have a lot of other money in the bank, and they put a line in the budget that says, oh, those are reserves. but it's not what we call a statutory reserve. The reason that's interesting is that they also have other funds in the state's bank account that aren't designated reserves, but they are functionally reserves. It's like extra cash in the bank. And there's about an extra $10 billion of those other resources. So this graph shows you the total accumulated value of all those different categories, which is really all of the cash that the state has on hand to manage fluctuations in revenue. Okay, back to the budget gaps. So again, the sort of big crux of budget negotiations is state spending sustainable? What are we on track to do? Are we on track to run out of money in the next year? And that's often how these budget gap projections are characterized. Remember, a gap is for a future year. They're looking at the revenue and saying, does it match our expenditures? So the yellow bars here, this is from the executive budget. This is not our graph. This is right out of the executive budget briefing. The yellow bars were basically last year's expectations of budget gaps. And the blue bars are the ones in the executive budget. So this executive budget projects actually a significantly better fiscal outlook in terms of the sustainability of state spending than those prior budget financial plans did. But they're still saying, there are big gaps. And that then becomes a constraint on what you can spend because you don't want your spending to push you into some sort of deficit position in the next year. But how do you make sense of these? Like, where do these projections come from? Well, one thing that's driving the higher gap in the final forecasted year, these financial plans project 3 years into the future. And in the third year, they have a higher gap. And that's because taxes are set to expire. In 2021, the state passed higher taxes on very high income earners and a higher corporate tax rate, but they tend to do these tax increases as temporary tax increases. So then when those expire, the state, or when they're planned to expire, the state plans to lose that money. That's not a debate that's happening right now, though it should, but in their financial planning, they're saying, all right, and in that third year that we're projecting, we are going to lose that additional revenue. This graph shows you in the blue bars, stacked on top of the purple bars, how much revenue we're getting from those tax increases. And the bright blue in 2028 and 2029 shows you how much is going to be lost if they allow those taxes to expire. So that's one thing driving budget gaps. But there's actually a deeper sort of structural thing to understand about these budget gaps, which is that they are very largely a product of forecasting. And so it's important to see them as forecasts and think about what the assumptions are rather than treating them as matters of fact. This shows you in the purple bar on the left what basically like a normal projected budget gap is. They're essentially always gaps because they estimate their revenue conservatively. And the executive budget's gaps are pretty much in line with those averages. And so those are the kinds of projections that we generally see reconcile themselves over time as the conservative projections are just sort of turn in as you update them, you see that revenue comes in a bit higher and those gaps disappear. This is a little bit of an interesting exercise in it that it shows you that very small changes to your revenue growth projections can completely eliminate those out-year gaps, and they can actually generate surpluses. And so this is the sort of deeper fiscal analysis question. Like, how do you think about the growth rate of personal income? Well, the current plan projects under 2% personal income growth. If you turn it up a little bit, those out-year gaps start to disappear. And if you turn it up just a little bit more to say 2.5%, 3%, the state starts to look like it's in a very good fiscal position with significant future surpluses. Generally, you would expect the personal income growth and revenue to track very closely because the personal income tax is the state's biggest source of revenue. And so the two should move together. This chart tracks the relationship between personal income growth and revenue growth. And while they generally move together, you can see that in the late 2010s, they diverge. And that's really because of tax cuts. So if you're cutting taxes, if you're giving away tax breaks, then you'll see revenue move well below personal income growth. But ordinarily, in the absence of tax cuts or big tax giveaways, they should move together. And so you can see the sort of tail end of the dotted lines in this graph. Those show you that the executive budget projects revenue to be reasonably below what it expects personal income to be. So there's this sort of unexplained divergence between their economic expectations of income growth and their expectations of revenue growth. This is a graph really of the COVID years where revenue tended to be much higher than expectations, but it shows you that same dynamic, that you have all these financial plans. These are in all the non-yellow lines. The yellow line is real revenues. And so the yellow line shows you how much over the past few years, revenues have really exceeded those projections. Okay, but let's zoom out a little bit. People like to say, oh, well, isn't the budget out of control, right? Isn't spending just unsustainable in some sort of big picture way? Well, how would you think about that question? If you read an article about the budget, it might say, oh, this year's budget is $233 billion, which it is the largest budget ever. Well, you would always expect every year's budget should be the largest budget ever, because as long as the economy is growing, the budget should grow with it. So to make sense of budgetary growth, you have to see it alongside economic growth, not just as a number of dollars. And here we track the size of the budget in relation to the state economy as measured by personal income, which is basically a good indicator of economic growth. And you can see that in those terms, the budget has actually been declining, that it has fallen from a height of about 9% to just over 7% of total personal income. There was a spike during COVID. It's sort of come down since then. And so the budget basically regained some spending capacity during the pandemic, but it is not the case that we've ended up at some very high unsustainable level of spending, given the overall state economy. Another thing you might hear is that revenue is slowing. Sometimes people say something like, oh, the good times are over, we have to live within our means, taxes are just permanently lower. And this is a little bit of an odd construct because, again, as long as the economy is growing, revenue is growing. Revenue grew really, really quickly during COVID. Again, due to various stimulus measures, many states saw very large surpluses. So the bold purple line here, that shows actual revenue. So it shot up and then it came down as you would expect it to, because you just wouldn't expect that spike to sustain itself. But the dotted blue line shows what basically like a normal revenue trend would be. And we're basically following that trend in terms of how revenues have actually come in. Okay, so that essentially concludes the first section of the presentation, which is on those fundamental fiscal features of the financial plan and how to make sense of things like budget gaps and what drives those projections, and just what is a reasonable expectation for revenue and the state's ability to spend. Now we want to talk about how does the budget approach a lot of the major fiscal policy domains that it's responsible for? Education, healthcare, housing, and climate will be the ones that we talk about. So 2 things to know in education. One, K through 12 education is funded by a formula that's largely based on inflation, as well as a number of other factors, to make sure that school districts get enough funding to maintain all of their operations and continue to pay teachers well in the face of changing economic conditions. The other is that, and so that's like a K through 12 school aid issue. And there's a second issue, which is that SUNY has an operating deficit. So how do we deal with each of these issues? Well, this year's budget changed that, or the budget proposes to change that foundation aid formula. Rather than indexing it to inflation, it would change the inflation calculation to look at the last 10 years, exclude high and low years, and come up with more of an average. And that results in about $500 million of expected increases to school funding being cut out of the budget. This shows you the difference between those 2 calculations. If you're really allowing inflation to drive it, you'll have much higher school aid funding in a period like the present where we've seen very high inflation. And you generally want school aid funding to at least follow inflation so that you can really maintain the quality of your operations. The blue line shows you this moving average, which would really be much lower in a year with high inflation, but it just kind of evens out and almost bottoms out a lot of this variation in economic conditions. Second point on higher ed, the SUNY budget is essentially flat, with one caveat, which is that last year, $500 million were put into this endowment fund for SUNY, and that was a one-time payment. So if you back that out, you basically have flat SUNY funding. And that's a problem to the extent that SUNY needs it's not a huge amount of additional funding, actually. $138 million isn't that much in the context of $130 billion in state operating funds. But if that deficit isn't remedied, it's expected to grow over time and could reach over $1 billion 10 years from now. So rather than making cuts, eliminating faculty, and eliminating certain regional or diminishing certain regional SUNY institutions, we really think the state needs to step in and shore up their finances. Just this morning, we released a report about the economic value of SUNY to the state economy and how, especially in a lot of more rural places with smaller regional SUNYs, it accounts for a pretty significant share of overall employment and wages. Okay, second point. I hope that felt straightforward because this is going to be a little bit more of a brain twister. All right, what's going on in healthcare? So two things, deceptively simple. One, there's a question about growth in Medicaid spending. And two, we have a lot of financially distressed hospitals that are virtually on the brink of bankruptcy and need funding. So what's going on with Medicaid spending? This really surprising little puzzle in the budget. So the state says it's concerned because Medicaid spending is growing by 11%. And that's particularly interesting this year because Medicaid enrollment is declining. During COVID, the federal government basically said to state governments, you're not allowed to kick people off Medicaid, even if they're no longer ineligible for Medicaid. Normally, people come in and out of Medicaid as they meet or fail to meet the income and asset requirements that basically say, are you poor enough to get Medicaid? So there are about 800 million people coming off the Medicaid rolls, and the state's projecting growth in spending. Some of that has to do with New York's very large aging population that's in need of home care, which is a relatively more expensive part of the Medicaid spending. This is also, or the finances here are also impacted by about $1.7 billion of expiring federal aid that the state will have to pick up. So that's an increased cost, but it doesn't track with increased services. It's just an additional cost that the state will need to bear. So the executive budget says we're going to deal with this by cutting $1.2 billion out of Medicaid. And some of the cuts are specific and we think pretty bad. So they propose cutting home care wages. Home care workers are generally low-wage workers who have fought very hard in recent years to get up to a more livable wage. And the executive budget would roll that back. It also prescribes $400 million in unspecified cuts and says, well, we'll just have to figure out where it's going to come from afterwards, which does not seem like the best way to handle a budget. But again, there's some deeper subtleties here because it's actually not clear that Medicaid spending is growing. The total amount of state Medicaid spending is actually declining. If you look at the all-in number, it's declining by almost $1 billion. But when the executive says they're concerned about spending growth, and now you're going to get like a 3-minute crash course in Medicaid. They're really talking about this purple bar, which is marked as DOH, Department of Health Medicaid. That's like people who are on Medicaid, who have Medicaid as insurance. That's DOH Medicaid. That's in purple. And so the state says, well, look, that's going from about $28 billion to $31 billion. So just in 1 year, that's a very significant increase in our Medicaid costs, and that's an unsustainable trend. But there's something funny going on here, which is that there's another big component to Medicaid spending. It's classified as mental hygiene spending, but it's a more sort of various category. There's a lot of stuff in there. So if you look at the blue bar up here, you might think that the executive budget is cutting mental health spending in half from over $8 billion to just over $4 billion. That sounds really bad, but we actually don't think that's what's going on. Part of that mental hygiene spending is actually a loan that was made to hospitals that's classified as mental hygiene spending. It's not spending on mental hygiene. And that's this green bar over on the right. But where it gets very interesting is the red bar, we think maybe misclassified Medicaid spending. That could just be ordinary Medicaid spending that should be part of the purple bar, but instead is packed into mental hygiene. And if you do the accounting that way, then Medicaid spending is basically flat. But it raises the question, why would they be doing the accounting that way? And there's a legal provision called the Medicaid cap, which basically just says, 10 years ago, they were concerned about Medicaid spending. And so they imposed this cap that says, well, we can only have so much Medicaid spending growth. And they might be over that cap right now. And they may have done the accounting in the budget to make it look like they're under the cap by transferring some of that spending in their accounting over into mental hygiene. And so again, we can't see behind the budget, but that makes sense of a lot of what's going on here. If that's the case, then that little red bar in the graph on the right should really be purple, and you would essentially have pretty flatline spending with cuts, sizable cuts here and there to Medicaid. And you wouldn't have this really high growth rate that they're concerned about. Medicaid is expensive, but we just don't think that that's an accurate representation of the growth trends. So one of the most concerning proposals for managing Medicaid costs here is cutting home care workers. Again, pretty low wage workers, not the place where you want to find savings. They've been fighting very hard for wage raises. This little table shows you that their wages were going up to $21, and now the budget is trying to take away the value of that wage increase. Separate issue is that we have many distressed hospitals. This is again, we don't have the underlying data for this. This is a chart right out of the executive budget, but there's a certain subtlety here to notice. This silly looking red line is our line, because this bar graph shows you all the bottom colors are state funding, but this shaded area above the red line that we drew on the graph is not funded. It's unmet need if you look at the legend. In other words, they've built in all this whole component of the chart that's just the money they don't have. So you can see that we've got over 70 hospitals in financial distress. That's about 30% of hospitals. Many of them only have a few days of operating expenses and cash on hand. And a lot of the state's strategy for handling hospitals' fiscal distress has been basically sort of ad hoc piecemeal solutions. And we need more of a permanent structural solution to funding distressed hospitals. But if you were concerned about Medicaid spending growth, there are better places to find savings. One of the ones that we're most interested in is that all those home care workers, many of them are managed by an intermediary called a long-term care plan run by a managed care organization. And they basically profit off of the administration of those plans, and it potentially costs the state billions of dollars a year. So by eliminating those plans and running spending directly through the state or through a more streamlined model, you would both have savings and be able to better invest, particularly in home care, which is, again, like I said, a fairly expensive but very important part of the state's Medicaid budget. That's a savings plan that could also turn up some money for distressed hospitals. It wouldn't be enough. You would need some sort of additional funding strategy to address the hospital issue. Two other things to note in healthcare. There is federal funding available to expand coverage for 150,000 immigrants. This is called the Coverage for All campaign. This is basically federal money. It really wouldn't cost the state anything. And so we think that should be included because it really meets important health equity and access goals, and it doesn't contribute to any of these fiscal challenges. The last thing we want to note is that the healthcare workforce got hit very hard during COVID. A lot of people dropped out of the healthcare workforce. This has contributed actually to some of the financial strains that hospitals face because workforce shortages can lead to a sort of death spiral situation. So there also needs to be a strategy to invest in that healthcare workforce and kind of bring it back up to a level where it's self-sustaining. Okay, that is enough on healthcare for now. But if you have questions, I am going to pass them off to someone else who will join us for Q&A, who's very knowledgeable about Medicaid. Second to last policy domain here, housing. Last year, you may remember, sorry, let me start in a different place. Two big picture questions about housing in the state. One, housing costs are high, rental costs are high. This is the biggest component in thinking about affordability for working New Yorkers, and in particular in understanding the pretty dramatic population loss that we've had in recent years. Second point, as a policy point, the state does not invest that much in housing. Partly a lot of housing is a local issue around zoning and regulations, but from our point of view, if you wanted to really tackle a lot of the housing challenges that we face statewide, you would need the state itself to take a lead in investing in solving this problem. So you may remember that last year's executive budget had this bold plan to promote the construction of 800,000 homes, largely through housing production requirements. And then it was also supported by almost $3 billion in tax incentives. We did that estimate. We had a lot of concerns about the tax incentive strategy, and everyone had a lot of concerns about the housing production requirements, which were never passed into law. But the basic idea here is right, that we need a lot more housing to tackle this problem. This year's budget, by contrast, is much, much less ambitious on housing. It has a few tax incentives that are intended to incentivize conversions to residential housing, to replace the controversial 421A tax break for developers in New York City who build affordable housing into their developments. It authorizes a little bit of denser construction in New York City, and then it repurposes about an existing pool of $650 million in grants and says, well, we'll use executive action to make these, to prioritize or really only make these available to communities that say they're pro-housing. A lot of this stuff actually lacks detail, and these are authorizing provisions for other agencies or localities to kind of fill in the details here. To give you a sense of what is causing this problem, New York has a very, very low rate of new housing construction. This shows you that we are below New Jersey and California, which have their own challenges, and we're way below Florida, which has, different, in some ways, different housing environment, but a much lower cost of living and lower cost of housing. Again, combination of regulatory issues around permitting and zoning and a lack of state investment is driving this. This reiterates that we've got some of the highest metro area housing costs, and that little yellow dot there shows you that the rise in housing costs has actually been the steepest among major American cities between 2012 and 2019. This just graphically illustrates what I've been saying about our population loss. That New York really stands out among US states as having very serious population problems. And as we've recently written about a lot, right now this is very concentrated in low and middle income populations. Bottom line, what do you do about this? So broadly, we think that this frame of social housing is a good sort of policy concept for thinking about how to solve housing problems. And the principle is just that you need to insulate a very wide range of low and middle income renters from the risks of the housing market. That can mean just rising housing costs, swings in housing costs, displacement. And to pursue or to realize that principle, you'd have to do a few things. First, you would really have to increase housing construction. There's no way around that. As long as we have a super limited amount of housing, it's always going to cause problems. But that's not enough. You also need a strategy to protect tenants from displacement by boosting and strengthening tenants' rights so that as that housing construction takes place, it doesn't really undermine, especially the sort of lower middle income segment of renters who are a little bit more precarious and who could be made much worse off, again, by some of the ups and downs in the housing market. And then there's a third thing that has recently been in the news because there's a legislative initiative to do this in New York State, but the state itself can finance housing construction through what people call a social housing development authority. And the idea is basically that the state kind of gets into the business of developing housing, Using debt financing allows this to be done fairly efficiently. There are tax benefits to state debt financing, and the strategy of a social housing authority that's a little bit different from some of the affordable housing policy that we've had in the past is that it can use a pretty wide mix or wide range of different income ranges, including actually just building market rate housing. And that allows it to make more money off some of the properties in the portfolio while subsidizing other low-income renters. And that is potentially a way to do a few things. One, directly provide lower cost housing, again, to low and middle income renters. But two, get the state involved in the business of building more housing that is actually provided at below market rates, thereby having an effect on the overall housing market. In order to pull that off, the state would have to build enough housing that it's not just about creating a few thousand homes for people, but it actually has an impact on the overall housing market. Inevitably, this takes many years, but that's, we think, the only real viable path to changing the housing affordability crisis that really a lot of New Yorkers have been dealing with for years. All right, the last substantive policy area we're going to go into is climate. And the question you might ask is, well, why is climate policy a budget issue? It's not, it's in the budget, but it's not a main structural feature of the state's budget in the way that education spending and health spending are. And that's true, but we want to draw your attention to a sort of core risk here in the state's climate goals. The state has ambitious climate aims under the Climate Leadership and Community Protection Act. And it's widely understood that some kind of public investment is needed to actually realize those aims, that you won't get an energy transition without some public incentives and some public funding of renewable energy. But the question is where that money comes from. And there are a few different possibilities. One is that you can just impose fees on businesses, and that's part of the cap and invest strategy that I'll talk about in a moment, and that basically funds the climate transition. Potentially, businesses just absorb those costs, but you're also likely to see that passed on to consumers. And so there's a scenario here where if the state does manage to meet its climate goals, it ends up really burdening energy users, that the end consumer just pays a higher fee or higher rate for their electricity use, and that finances hundreds of billions of dollars in a climate transition. That wouldn't be in the budget, but it would affect all of us just as though we were subject to higher tax rates. So the alternative is to have a proactive state investment strategy where we look to ways to raise revenue in a more progressive fashion so that we're clear on who's actually paying for the transition and avoid an outcome in which the state either misses its climate goals entirely or ends up forcing this lower middle income population to disproportionately bear the costs of those public investment needs. Brief overview of the goals. The goals are to reduce greenhouse gas emissions and to transition to a fully electrical grid. We have interim goals by 2030, reducing greenhouse gas emissions by 40% compared to where they were in 1990, and 70% renewable energy or grid electrification by 2030. That's only 6 years away. And then by 2040 and by 2050, they have their ultimate targets of very significant greenhouse gas emission reductions and having a fully renewable grid in New York. Part of the act also explicitly prioritizes equity and justice for what they call disadvantaged communities, partly in recognition of what I was just saying, that there's an outcome here where the wrong people end up bearing a lot of the costs of this energy transition. This is from the state's council that's responsible for implementing this whole act. And it shows you the distribution between public spending and private spending that they expect to be necessary to accomplish all these goals. So market's already moving in the direction of renewable energy in a number of ways, just in how you see people buying electric cars. So there's some private sector activity that will on its own just affect part of the climate transition, but it probably won't be enough and it probably won't move fast enough. So that is the source of the risk that we don't actually meet the climate goals. And so you need some public spending to either make it faster, more affordable, especially for a lot of renewable energy investors, to do things like build offshore windmills, or sort of lay new electrical grid, or convert buildings to not using natural gas, where maybe they wouldn't do it on their own because of the cost in any sort of near-term period. The state does have a strategy for handling those costs. It has a program called Cap and Invest that it plans to use to raise enough revenue just through that program in order to pick up that share of public investment needs in that graph I just showed. And the way that Cap and Invest works is they say, all right, well, lots of different businesses that give off greenhouse gas emissions have to report to the state their emissions levels. And then we're going to impose a cap on how much, this is your sort of basic allowance of how much you can emit. And then we'll auction off allowances that permit you to emit over that cap. And this is a way of basically making it costly to go over the cap while raising money to finance climate investments and start to transition the grid and build new renewable energy sources. The interesting subtlety here is that it sounds good, and it may be good because you're trying to burden, say, energy companies that emit a lot of greenhouse gases, but there are real risks in the program. One is that, again, like I said, all the costs end up being passed on. Another is that when they actually establish these rules, because this is a framework, but the specific rules don't exist yet, and this is how it's happened in a lot of states, the people who are tasked with deciding what some of the numbers are and who exactly has to do what say something like, oh, well, we wouldn't want to make it so expensive for all these businesses that are based in New York to actually comply with the rules. So we're going to add something like a price cap that says, well, however much you're paying into this Cap and Invest program, you can't pay more than X dollars because it would just hurt the businesses too much. Well, again, this has happened in a lot of these Cap and Invest style programs, but that completely undermines the function of the program because now you're not incentivizing the right kinds of behaviors. You're essentially allowing people to blow past the policy aims of the program. And so then it ends up not working, both in the sense that it doesn't actually get you to your climate goals, and it also doesn't raise money that you can use to invest in that energy transition. So you need to have other strategies teed up to come up with a financing source to meet those goals. The other thing the state has done is it's authorized over $4 billion in this Environmental Bond Act in order to come up with a debt-based source of investing in the climate transition, but it hasn't used very much of the money. Under their current projections, it looks like they're only drawing down about $100 million annually. We don't entirely understand why that is, but it's just, it does not seem to be, doesn't seem like they plan to really leverage. There's a pretty significant amount of debt financing to supplement some of their other strategies for the climate transition. Let's just review some of those risks. Why else might Cap and Invest not be implemented successfully? Exemptions, limitations, no revenue coming into the program, enough revenue coming in, but burdening consumers. Again, all those are really climate policy concerns. They're not in the budget, but if those things come about, this will probably end up being a budgetary issue because we'll get to the point where the state is clearly not on track to meet its climate goals. People are very unhappy about that. And then we have to start looking for other ways to pay for it. So we think the right way to handle this is to be very proactive about it, to say, okay, maybe Cap and Invest will work out, but let's proactively find progressive revenue sources that we can use to increase state investment in some of these immediate needs to jumpstart the energy transition. The last thing I'll go into before we shift to questions is just what's on the table when it comes to tax policy. In order to understand what's possible here, we have to look at the sources of the state's taxes. And the biggest source of state tax revenue is the personal income tax. And within the personal income tax, very high earners, they contribute almost half of personal income tax revenues. This comes up very frequently in budget debates because there are concerns that if you raise taxes on the rich, they'll move out of the state. And there's also a concern that somehow it's unfair or doesn't make sense for the state tax system to be so heavily reliant on this small number of people. And what that debate tends to leave out is that that small number of people, they earn a ton of the income that is collectively earned in New York. This shows you all personal income earned in the state. And these colored shaded areas on top show you how much those making over $1 million earn of total personal income. And as of 2021, people making over $1 million earned over a third of all income earned in the state. And they paid about 44% of all income tax liability in the state. So the meaningful number isn't just that they pay almost half of all tax liability, it's that they make 35% of all income and they pay 44% of all income tax. So that shows you that there's a little bit of progressivity. They're paying a little bit more than their share of income, but it's not disproportionate. And really, they ought to probably be shouldering a larger share of total tax revenues. On the flip side, the personal income tax is actually pretty flat for most taxpayers. We have higher rates on people who make millions of dollars a year, but most of the personal income tax is within this small band for about 99.5% of taxpayers. This shows you the rates for married filers, and it steps up a little bit. But again, for a married couple making up to $2 million, they pay what is a very moderate tax rate by national standards that is not that different from what very middle income families pay. So what are the arguments that people make? They say, oh, it's unfair, they pay too much. If you raise taxes, the rich will leave, and our taxes are already so high, you can't do it. Well, we just showed you that for most people, the taxes aren't that high. But what is the deal with the highest earners? So first of all, we recently did a very big study about these migration patterns, and we found that the top 1% of New Yorkers typically move out of the state at about 1/4 the rate of all other groups. And when they do move, they normally move to other high tax states like New Jersey and California. So there's really no evidence that this idea about millionaire tax flight has any purchase on reality. To the second point, how high are our taxes? You'll often hear a talking point that we have the highest income tax rate in the nation. And there are two subtleties here. First, that's true if you add together the New York State income tax and the New York City income tax. And you're only looking at the top bracket, which applies to people who make $25 million a year. That's a very small group. If you look at other states that have comparable tax structures, they impose their top rates to people who make like $1 million a year. Or in the case of Hawaii, people who make $200,000 a year. So it's a little bit of a sleight of hand to talk about New York's super high income tax rate without acknowledging that it's on a very small number of people who earn like world historically high annual incomes. What could you do to start to remedy this? Well, one thing that's very simple that you could do is just collapse those top brackets so that the top rate that's paid by 25 millionaires just is paid by anyone who earns over $1 million a year. And that would make us more like our peer states. And that would raise over $2 billion a year by our estimates in new income tax revenues. But it would actually be better to increase the progressivity of the state's tax structure and break up some of the flatness in the tax rates that apply to those high earning couples and individuals who aren't making $5 million a year. And that would just about double the revenue yield to about $4 billion. There are more detailed proposals in the publication that accompanies this briefing, but we just wanted to keep the summary figures here. The third thing you could do that would be bolder and a little bit more serious would be to maintain some of the high-end progressivity, but more meaningfully raise the rates on these ultra-rich income earners. And that can raise upwards of $10 to $12 billion annually. Again, all the brackets are in the book, but big picture, that's what it would look like to start getting serious about the progressivity in the income tax. There are a few other options on the table that potentially raise real revenue, though typically on a lower scale than the income tax. The state could look at offsetting the federal tax benefit for capital gains. Basically, it's a tax benefit for investment income. There's room to raise the corporate tax. The corporate tax was cut in Donald Trump's 2017 tax law, by 14 percentage points. There are measures that the state could adopt to combat corporate tax avoidance and multinational profit shifting. There are a lot of businesses that don't pay the corporate tax at all because they're not organized as corporations. Those businesses shouldn't be exempt from business taxes. And then there are a lot of measures that could be imposed to tax inherited wealth. We think it's important to talk about the ultra-rich in terms of their income and how that relates to inequality and what that means for the income tax base. But there are plenty of policy reasons to also think about what that means in intergenerational terms and starting to change some of the very, very significant exemptions that allow people to pass on essentially unlimited amounts of wealth to their heirs. So that's the end of this part of the presentation. Now we're going to go to questions, and I'm going to bring in our other FPI staff who will be happy to answer them. Michael? All right.
Yeah, do you want to maybe tilt your screen so that Michael's in your camera? And
yeah, we'll do
his camera.
Gotcha. All right. So let me add.
Okay, but we should also talk to not to the...
All right. So we've got here. Are you guys muted?
Yes.
All right. I've got over here Andrew Perry, FPI Senior Policy Analyst, and Emily Eisner, FPI's Economist. And this is Michael Knukin, who has been our Health Policy Advisor for this part of the budget. So
we can start with one question that I answered in the chat, but we got it a couple times, so maybe I should just go over it, which was a question about whether federal funding is included in some of the revenue and spending figures that Nathan went through towards the beginning. And the answer to that is that throughout the presentation and briefing book, we mostly deal with state operating funds, which excludes federal funding. The reason for that is to really hone in on the state's resources that the state spends on programs of its choosing. Of course, federal funding is especially important for Medicaid, so we address federal funding there. But in general, we're just using state funds, so tax revenue spent on state programs.
Do any of you want to? Yeah.
Going back to the CLCPA, that one chart had public spending at $5 billion, and by the time we get to 2050, if I got that right, it would be $40 billion for the private industry. Would that change the dynamics of privatizing energy provision? Would take it out of the public sector? I might have misread the chart.
No, you didn't misread the chart. These numbers come directly out of the scoping plan of the CLCPA. But actually, sorry, there's one part of the chart that doesn't come out of the scoping plan. It's just the breakdown of public and private. So they produce the cost estimates total for the CLCPA transition and don't do the breakdown. We applied our estimate of how much would need to come from the public sector to like kind of complete this. Does that make sense?
It does. So with them spending that much money, would they take ownership of all the wind farms and the utilities?
Oh,
can you just repeat the question to the Zoom audience?
I'm not sure if I'm asking the question correct.
Yeah, sorry, he just wants me to repeat so that the Zoom audience can hear it. I believe the question, and you can sort of see the chart behind me. It might be worth putting the slides back up for the Zoom audience. Okay, so I believe the question is, how the fact that so much of this spending is private will affect sort of the market and who sort of like owns the energy, like the grid, basically. And actually, these private costs, Andrew, just correct me if I'm wrong, it's like, this is speaking to like both businesses and people. It's like the total cost. So like this would include people buying electric vehicles, like households. So it doesn't mean private, like who's going to own the grid. It means like non-public sources of the transition. So it does include like investment in wind farms made by a private company.
It's a purchasing of buildings that are bought or electric.
Yeah, exactly. So a household that decides to switch their heat to heat or their, climate controlled heat pumps, they might spend their personal dollars on most of that transition and get some public money to sort of help them take the cost. But it's basically like we're showing like that some of this cost will be borne by the private sector, including households and businesses.
Yeah, I'll just add to that, that with a wind farm, the way these deals are currently structured is that the state makes a deal with the wind farm developer to purchase energy at a specific price. So they'll build that with their own private dollars. Once that's producing energy, the state buys this. So really those costs are absorbed by us, the ratepayers who use electricity in New York. So those are private costs for this accounting purpose. Yeah, thank you.
Yeah.
We've got a question on cuts to home care wages.
Yeah, what's the question?
Just can you say more about them?
Yeah, I mean, this budget includes really dramatic kind of draconian cuts to home care wages for workers in the CDPAP model. So home care is, funded through Medicaid in the state, and it's provided, simplifying a little bit, through two models. There's a agency model where home care workers work for an agency, and then there's consumer directed personal assistance where workers are paid through a fiscal intermediary. They're selected by the Medicaid beneficiary. A lot of folks in that model are family caregivers, and it's been a big growth area for home care spending. And the governor is proposing $200 million state share in fiscal 25, rising to $400 million state share, $800 million, including federal money, in wage cuts for those workers. This would actually cut, I want to emphasize, this isn't a cut relative to projected raises. This would be an absolute rate cut of about $2, $2.35, I think. For these workers, I will just say it's very hard to imagine the legislature accepting this. Likewise, it's a little hard to imagine the other 400 million in Medicaid cuts that are sort of unspecified going through. So one struggles a little bit to understand what the governor's theory is in proposing these kinds of cuts.
Can I add
Yeah.
on one other thing, which is that I believe someone asked about sort of what form these wage cuts are taking, and they're a cut to the wage parity that applies to sort of downstate home care workers.
Yeah, that's right. And this applies only to CDPAP workers, not to agency model workers.
Sorry, we got a question from the audience.
So your slide on CUNY, have you done a breakdown of how the 2-year versus 4-year colleges are affected by deficits? And have you done any sort of further breakdown between, I guess, the 2-year and 4-year?
The question is about SUNY. Have we done a breakdown between the 2-year and the 4-year colleges on the deficit?
So the deficit figures that we have in our presentation are 4-year campuses. The breakdown, the $1 billion that gets kicked around, estimate for the end of the decade, comes from a report that was put out by the SUNY Central Administration. I believe that's state operated campuses, which are 4 years. I think I would have to double check that, but yeah, that comes from the SUNY Central Administration. Because I believe the number we're cited is definitely just 4-year colleges.
I think Andrew, you can take the next question too. So this question is interesting. It says Governor Hochul committed to Cuomo's policy of limiting budget growth to 2%. And how does that affect aid to localities?
This is an interesting question. Is Governor Hochul committed to 2% spending growth? I mean, certainly Governor Hochul took office during COVID, during which state spending growth was, as we showed, well above 2% per year. This is not something that Governor Hochul really emphasizes, whereas Governor Cuomo, of course, made it this 2% spending cap really a centerpiece of his budget presentations. So I don't know how the governor would comment on her saying that she's committed to, is she committed to this growth cap now that we're sort of in the aftermath of COVID and we are growing at this much slower rate. We are growing at 2%, but it's certainly she de-emphasizes it or doesn't emphasize it at all. And then how does this affect state aid to localities? The two big buckets of state aid to localities we went over in some detail are school aid and Medicaid. As we showed, both school aid and Medicaid, the governor is proposing pretty sharp curbs on spending growth in both of those areas. So, state aid to localities is about 2/3 of the state operating budget, so it's most of the money. So if you want to start to really curb spending, that's where you focus, and that is where we've seen the focus. So certainly she's trying to really slow the growth in those areas.
Yep.
Two parts. I was wondering if Don would have a breakdown of where the bond spending is by subject.
The Environmental Bond Act,
Well, just in general.
all debt spending.
Yeah, especially with like on housing, and then you mentioned the $4 billion bond act. Are there like restrictions around that funding, or does that go? Rehab it?
The question is about basically state capital spending and debt, and if we have an analysis of how the state's debt is being used, and also for the Environmental Bond Act that we mentioned, what that can be used for.
I can speak to the Environmental Bond Act, which is not by any means the majority of the debt spending happening. So there are restrictions on how it can be used, and there's like goals for how it's used that are, I don't have them right in front of me, but a lot of it is also about like protecting like climate resilience. So like flood risks and things. One of the ways it has been used over the last couple of years, and that it's going to be continued to be used, is transitioning the school buses to electric vehicles, which is actually really good, and the state should do that. I think from what I know, the transition to like electric vehicles as consumer products, are on the rise. Like many more people are buying EVs, but for large vehicles, it's very costly to make the transition. So the fact that the state's investing in these electric school buses is good. But as we showed you, like they haven't even dipped into very much of the Environmental Bond Act at all. Like they're like below 100 million of issued debt right now, and the limit is 4.2 billion. So it's really hasn't been leveraged very much. I can't really speak to
The overall capital program.
Yeah.
Yeah, the overall capital program is something we look at. We haven't really, there's not much in our presentation, and you find that it's fairly broad-based. It's transportation is a very large, transportation and economic development are really large pieces of it, and then certainly school construction are major pieces of it, but it's fairly broad-based across all spending areas. So yeah, I don't think we have any.
Well, yeah, it's kind of yet to be seen how meaningful this is, but like the state did make some changes. This is not like a funded change, but to how the dormitory authority, which is a bond issuing authority in the state, can use its power and tools, including state like planning construction projects for climate issues. So there's been an expansion at the state level of like what certain, what this state authority is allowed to put its resources towards, but yeah, it's not clear yet how that will play out.
Okay, the next question is a health question, so Michael's gonna.
Yeah, sure. So this is a question from Gail about the long-term outlook of state policy on aging and how that affects spending. The state is developing a master plan on aging, and it's implementing an should be implementing an Olmsted plan to increase HCBS. And she's asking sort of how does that play out in the long-term fiscal outlook of the state? It's interesting. The governor's budget talks a lot about the fiscal challenges of an aging population. We know, a quarter of the state's population will be over 60 pretty soon. But from what I can tell, that problem is not actually incorporated into projected Medicaid spending. I can't see any evidence that the state projects, for instance, increasing enrollment in Medicaid due to an aging population. The Medicaid population is projected as totally flat out to 2028. So my sense is that there's a little bit of it's clear that the state is sort of thinking about the long-term fiscal challenges, but there is no projected financial cost to them. So that I think that's in the longer term, a real financial risk for the state.
Could I add
Sure.
on a tiny bit, which is that last year we wrote a report about home care wages as being important to meeting the like amount of home care needs. So as Michael said earlier, it's like unlikely that the cut to home care wages will be passed, but if it were to pass, it could have like pretty serious implications for meeting the amount of need in the state.
Any other live audience questions? Got nothing else in the Zoom chat. All right. Well, that wraps it up. We will be momentarily or have sent out the budget briefing publication. It'll also be available on the website. It's long. It's like 100 pages. There's a lot of good stuff in there. You can read it section by section. You don't have to go from page 1 to the end. If you have any questions, feel free to get in touch. We're happy to talk about anything in there and to discuss how to potentially make some changes as this year's budget actually gets done. And so thanks for being with us.